Welcome back to The Edge, everyone. And in this segment, we're going to be talking about top five investments that everyone must have before they turn 50. And I'm still delighted to be joined by Dipo Ajayi. Dipo Ajayi is head fixed income and vice president at Chapel Hill Durham. Also, still with us is Adra Ojo. Adra Ojo is a chartered financial analyst, an accountant, and wealth management expert. Gentlemen, thank you for staying on. All
Thank you
right.
very much for having me back.
Thank you, Doctor. Thank you for having me.
Okay. So, this is a pertinent question or discussion to have. By the age 50, many face what in Bureau Vera Finance we call retirement cliff, right? And research has shown that inadequate planning leads to about 30 to 50% income drops. Family dependency, building building foundation early, I would say, will prevent this form of retirement cliff that we'll talk about for people in their 50s. It was Morgan Housel who notes in his work on the psychological of money that says that wealth is what you don't spend. All right. So that is what he described wealth to be. So many Nigerians in their 50s today are either struggling to pay school fees for children, they're facing forced retirement, difficulty getting new jobs, or relying on family for support. So why is it so important to build a solid investment foundation before turning 50? And what kind of painful realities does this help to prevent? Deepo, what do you make of this, and what's your 2 cents on this?
Well, there's a professional that I listened to one day said something very, very essential. He said, for every income you earn today is to cater for yesterday expenses, today expenses, and for your future expenses. So it means that if you earn 100,000 naira today, there is future expenses that's in that form. So it simply means that you cannot spend the money for future expenses today. So what do you do with that money? You set it aside. And you don't just put it in savings account. You set it aside to prepare for that future, just like what you have highlighted. And for me, there's this analogy that always comes to mind. When you're starting your career, you are like someone on a bicycle. You can turn anywhere in the world. When there's traffic, you just imagine yourself that you are married, you just started your career. You can wake up today and say, I'm relocating to Canada. But when you are married, you can't just wake up and say you are relocating to Canada. You already have a weight on you. So it simply means that at that point, you are more like a car that need to turn. When you want to turn, you must trafficate and ensure that the course is clear for you to turn. And when you now have children, Dr. Tony, I make it to say to you that you are now a train. You cannot turn until when you get to a terminal. The course must be extremely clear before you can actually make such U-turn. And how can you make the course clear? It's just like what you are saying now. You need to have prepared for that day where you need to make such decision for you to actually make those turnings. And as you're growing, there's a lot of investment opportunity that is available for you to actually put in your portfolio that could actually help you prevent that day that you will not be unable to actually fulfill your financial obligation as when you're starting your career, your financial capital is very low, but you have huge human capital. So what you need to do is that you need to find a way to actually maximize while you are converting your human capital to financial capital. you must ensure that you are not consuming the financial capital. You are putting in the financial capital in the investment that will protect your future. And I'm sure as we speak along the line, we will dissect some of those assets where you feel that you can actually put your fund in to prevent a situation whereby you're unable to actually meet your financial obligations.
Yeah, that's key. So Adira, what do you make of this? Why is it so important to build a solid investment foundation before turning 50? I mean, does it? Are we over? Is it that we're overemphasizing the age of 50, or do you think this is just making necessary noise about the age of 50? Why is it important actually?
Yeah, not at all, doctor. It's very important because you know that age is the is the is the late career age,
Okay.
right? 50 and above is your late career age, and at that age, um, you have your risk appetite begins to drop,
Mm-hmm.
right? Just like Dikko said, your human capital at that point begin to drop. Your human capital is the economic benefit of your skill, your professional experience. I mean, your professional development and work experience, or your personal attributes.
Yeah.
The economic benefit of being a person, a human being, is embedded in your human capital. So
Yeah.
by the time you are 50 and above, then at that point you are close to retirement. It means that whatever you have not it when you are setting a target, for some of us that are conversant with budget setting, when you set a
Mm-hmm.
budget and if halfway you have not met your budget, what it means is that your run rate increases. It means that for you to meet that target, you have to do more to catch up, right? So meanwhile, between 50 and above is a period of time when risk capacity begin to drop also because of age and an inability to cope with losses, when they occur. Because when you retire and you don't have earnings coming in, so there is nothing to convert to your financial capital, right? What are you going to convert to stock and bond or real estate? It's no
Yeah.
longer that time. So it's very important. It cannot be overemphasized that as you are attaining that level, if you have not done a lot of work prior to that, then the risk, there is one major risk that you are standing, is called longevity risk. Is the risk that you will outlive your asset. When you outlive your asset, it means
Mm.
that you outspend what you have. For instance, if you have a career between 30, you spend 30 years in employment, and
Yeah.
God helps you, you now spend 40 years outside employment, and you now your your life expectancy, you are now 90. You get the point. So from okay, let's even take let's say okay, 60 is the retirement age, right? Between
Yeah.
60 and 90, if God helps you and everybody pray for longevity, and it means that you spend 30 years in employment, 30 years in. So if you don't have sufficient, asset in place to take care of your post-retirement, expenses, then what it means is that you are going to face longevity risk, your asset depletion, and at the end of the day, you'll be worse off for it. So that's why it is very important.
Mm. That's deep. So Deepo, if you could recommend 5 key investments or assets that everyone, every Nigerian should prioritize before turning 50, what would your list of investments and in the order of importance be? And why is each one of those ones critical?
Well, I think the first on my list would be equities, and because that is a point where you can still take risk, just like what Adra has actually mentioned. If you're actually on your way to 50, it's a point where you can still take risk, considerate risk. And so if you need to actually take considerate risk, it means that you can say you have room to actually load equity into your portfolio. And for me, equity is more like portfolio amplifier. Because of the level of return you can actually gain from actually investing in equity market. And we can look at some of a lot of example in the Nigerian market. Look at, I'll give you some names. As of 2017, 2016, Okomu was trading around 14 naira. Okomu is trading north of 1,200 as we speak now. Same thing with Presco. So imagine that you have invested in such name now, even with the level of inflationary pressure that we have seen and depletion of the value of the currency, one way or the other, you have still been able to actually edge yourself. Because one thing, the equity can bring a bit of edge, most especially if the particular company can transfer the cost of this thing to consumer. So it simply means that they can actually bear, you can actually get your investment hedge. So equity will rank number one for me. And beyond equities as well, there's the aspect of bonds as well. Bond, like what we say, it helps you to actually, the advantage of bond is the predictability of your cash flow. You mentioned you want to pay school fees, you want to meet an obligation. There's a way you can structure your investment that you can actually structure it in a way that you tend to get those cash flow coming in at that particular point in time where they are mostly needed. And that's one of the reasons why you have you need a bond in your portfolio. There are points in time where, imagine you having like January 2035 bond in your portfolio. The bond that has coupon of 22.6% coupon. It means that for every 100 million investment, you have a cash flow of about 22.6 million as cash flow annually that comes to your hand over a period of the 10 years. So it gives you an idea of how you can actually use the predictability of that cash flow to actually plan your investment and also meet your financial obligations as a when you. And beyond that as well, there's the aspect of real estate as well. And there are times that people, when you talk about real estate, people tend to look at it, buying of land, buying of building, some of these things. There are times that you don't have the capacity to actually buy some of these things, but you can buy into listed names on the exchange and actually are actually tracking some of these things. I think in past segment we talk about some of these ETFs that we can actually use to actually take advantage of some of these things. You have NREITs on the exchange, you have UPDC REITs on the exchange, and you have a couple of other names that they are real estate investment trust assets on the Nigerian exchange. And what it will do is that they help you mimic what is happening in that sector. And so it simply means that whatever the return that should have accrued to anyone investing in that sector, you can also be partaker of such a level of benefits. And another thing that comes to mind as well is the commodity. And we have spoken about our mothers. A lot of them pay their school fees with commodity. Don't forget that an average Nigerian woman in Isaleko has gold stored in their house. They use this as jewelry. They use it as accessory. And also is a form of investment for the future. And that is a way that you can also layer your portfolio, investing in commodities. That what it will do is that it helps you to preserve the value of your assets. Don't forget that some of these names, like this commodity we're talking about, gold is denominated in dollars. So when you're investing in dollar, one way or the other, is a way to actually diversify your assets in currency basis. So it means that you are not totally exposed to only Naira. So it simply means when there's volatility, your investment in commodities like gold could actually help you to mitigate the level of risk that your portfolio would have actually witnessed. And the last on my wheel will be money market. Money market, what it does to you is more like your bank account. It's more like your paycheck. Instead of you leaving your money in savings account, leaving your money in current account. When you put money in money market account, you tend to enjoy a better level of cash flow. And another thing also, it helps you to be more disciplined. If you have money in current account, you can log into your app and do your money, and you do the transfer and do whatever you want to do. But sometimes when you know that it's in a money market asset account, what you need to do, you need to actually fill form. You need to liquidate. You need to, when you look at the stress that you go through, it sometimes limit the level at which you want to go through that route. And until when it is very, very essential, that's when you want to actually toll that route. So for me, I think this level of five asset class that I've mentioned are from equities to bond, from bond to real estate to commodity, and I will rank money market as the lowest on my CADA because that will operate more like your savings accounts.
So great. So you talked about bonds, real estate, equities, commodities, and money market. These are five investment types that you've identified. Adira, what's other types, or do you share similar investment types with Deepo, or do you have other types of investments that you think every Nigerian or everyone should have before they turn 50? And if you may, what are some of the common mistakes that people make with it?
Okay, thank you, Doctor. You know, the work of advisory is a very complex one, right? Of course, you have different asset classes that are there,
Yeah.
both traditional and modern alternative that you can put your money in. But beyond that, the wealth journey, right, starts from you, which is your human capital, which is the totality of who you are. If I were to recommend to anybody who wants to do investment, you start from yourself, right? Because the foundation of any wealth creation is human capital. If you, whether you are an entrepreneur or you are a business person or you are a professional, if you don't invest in yourself, then most likely what you are going to have is any risk, which if there is any macroeconomic volatility, it can take you off the job. If you are not in a dynamic industry where you can weather the storm, it will take you away. So if you want to start, you have to start with yourself, build yourself, get sufficient education, skill, experience, whatever education that you need to. If you are in the business space too, you need to build yourself in that space. When you build yourself in that space, as you begin to grow, then you begin to manage your human capital. You begin to, because even as a businessman, you know, you can, when you grow to a certain point, you can have this sentimental attachment to your business. You don't want it to, how do I, at the point you know, you have to start to plan your exit from that business. How do I exit from this business? How do I monetize? So all those decisions will start to coming. Then you can begin to, as you are between age 20 and 35, which is the early career stage, 35 to 50, 50 and above. So within those life cycle, there are specific, I mean, your risk appetite, you know, also change along that line. So, and whatever recommendation you are, it's easy to, you know, to say, go and buy stock. Somebody who is age 50, I just say, go and buy stock. I need to know what are your goals? What do you intend to? Because at a point, your living expenses, if you partition this into risk buckets, you discover that your living expenses shouldn't be invested in risky assets, right? So for instance, you can your living expense, it should be, you know, it should be in safe asset, such that the probability of missing that outcome, you know, be very low. So when you now have aspirational targets, you have gifting intention, you want to, your legacy plan, or you have a philanthropic intention. So those one, they are long-term investments. You can push those portfolio, you can push them into, risky. So depending on what you want. So along that line, there are risk. Different asset classes you can partition and put your resources into as you grow along the line, so that you will not you will not. It's good to set a goal, because at a point your expenses will even outweigh, as you are growing, your expenses will even outweigh your income, but over time. But as you grow, so you know that between age 20 and 35, this is my early career stage. I still have student loan to pay, I have this one to pay. As you are moving to 35 to 50, of course you will have grown at that level. You will have been in senior management level. At that point you have a lot of resources. You also have competing demand. You'll be paying for mortgages, paying for a lot of these things. So you have competing priorities, that are, that demanding on your resources. So at that point in time, you need to begin to look at, how do I allocate some of these resources to all the different asset classes, so that I can meet my retirement goal, and I can retire safely. So that's, for me. Start with yourself, then thereafter you now have the different, like Dikbo said, you have all the other different asset classes that you can now invest in, depending on where you are in each of this stage of your your financial life cycle. So that's the way I can attack.
Okay, let's get practical, Adura. So let's say for someone in their mid 30s or 40s who has very little or nothing invested yet. So what are the practical 4 steps, okay, that they should take immediately, based on all of this? Because I understand when you say invest in yourself. Okay, can you break this down and tie it down? Tie it again to these age brackets that we've talked about, so that we can get something that followers, our viewers can hold on to. I'm in my 30s, I'm in my 40s. What should I do now?
Okay, so if you are in your 40s, okay, let me, like, I have broken
30s,
down.
30s, yeah, 30s,
Yes,
40s.
between 20 and 35, you are just coming out of college, right? You are
Yes.
entering the job market. You are just
Mm-hmm.
starting your business. If you are starting your business, of course, the cash flow will be negative. So you have a lot of obligation. You are getting married. You want to buy a car. You want to buy a home. So those periods, your cash flow will be negative. But as you move between 35 and you are advancing your career, right? Then you discover that your cash flows will be getting better. And as you are attaining seniority level in your organization, or your business is becoming more matured, then you are getting some cash flow. At that point in time, then you need to begin to put some resources aside, just like Dikbo said earlier on when he was talk about, human capital. You begin to deploy resources to your financial assets. When you are
Okay.
at between 35 and 50, you have your asset allocation. Normal asset allocation will be riskier investment, right? Because you still have a long time to weather any storm. At that point, equities will be suitable for you. You will have, even if you invest in real estate, whether commercial property or whatever type of real estate you want to, even at times you do residential that you can even dispose of. If you invest in choice areas, right? Those
Yeah.
investments can be good, because if you need liquidity at that point in time, you have enough time to convert this asset to so stock investment is a very long-term investment. At that point in time, when you are getting to between age 20 to 35, they are not period that you should be focusing on fixed income, right? Because fixed income will not give you that level of growth. Your risk appetite is very high at that level. Then you can
Yeah.
deploy resources more into equities. You can do more of stocks. You can do exchange ETFs, right? You can gain exposure to, other alternative investment, or you want to have gold ETF. These are, modern alternatives that you can gain exposure to, right? They can give you growth. If you look at the growth, if you look at the price I've been following gold since 2015 when it was 1.5. Today is 4,000. It got to 5,000. It came down. It's still
Yeah, I got
a
about
positive.
5,600 or
Yeah,
thereabout.
yeah.
That's
So,
the last time I checked, right?
and if you look at the projection, is going to go up. Even the Bitcoin that people don't understand the fundamentals, right? Those assets they have potential, but depending on your risk appetite and your age range, where you are in your financial life cycle, right? So as you are attaining 50 and above, of course at that point you are planning for retirement, right? Yes, 50, 10 years and above. If you have 50 to 60, is still okay, plus your additional life expectancy, let's say 75. Well, 25 years is a long term, I mean, but depending on your goal at that point in time, what do you want to do? Okay, if you still have children, you have obligation in USD, then it will also determine your asset allocation, whether it's going to be domestic asset allocation or whether it's going to be foreign. You are going to, because you have obligation in USD. So some of these things will determine, how you do your asset asset allocation. So that's I hope that breaks it down.
Yeah, that clarifies it.
Yeah.
For Deepo, for someone already in their mid-40s now, with almost nothing saved, is it too late? And are there any accelerated strategy, to catch up that you can recommend so that they can still build some meaningful wealth or have some meaningful investment before they turn 50?
Well, there's this adage from where I am from that whenever you wake up, that is your morning. And but they're just waking up, that is their money. And but just the fact is that they are not waking up at the right time. And so just like what Adria mentioned earlier on, if you have missed your target, it means that you have higher run rates. So it means that they have higher run rate now. And don't forget that the capacity to take risk is not so much there because, like I said earlier on, I was telling you that you get to a point where you have so much obligations that you are like a train you can't turn anyhow. So they are getting to that level where they cannot turn anyhow. So it simply means that when you want to invest in this level, you need to be very, very careful. And why do you need to be very careful? Normally, what would you have expected is that you would have built financial capital over that long time while your human capital is depleting. But now you have not been able to build financial capital, but yet your human capital has actually been depleted. So what it simply means that it's a point where you have to act now. There's a lot of things that you need to do at this particular point in time. There has to be risk profile because it's not a time that you want someone to take a risk and say, oh, the market has crashed and someone will have IBP. And the next thing is that the person may actually lose their life. And so it's a time where you need to be able to sit down with this person, profile the person, and know what Adra actually mentioned. There's a lot of things we actually look at. You look at your aspiration needs, you look at your philanthropical needs, and many other things beyond your normal needs. So if I know your cash flow is this, we can actually plan your investment strategy around your future cash flow obligations. If it's something that, so it's a point where you can aggressively do stock or do aggressive risky assets. It's a point where you can actually put some fund in this thing, but not so much risky that if anything happens, it can actually jeopardize your future aspiration or your future need. So this, for me, if I see someone that is this level, it means that you can't do equity more than like a 30 to 35% window, or maybe 30 to 40 window. So you still have that 60% headroom that you can play with in conservative investment that can actually give you cash flow that are predictable and can also help to actually help you stabilize into your future. But the good thing about it is that in investment, there's something we call the core and the satellite. What this will be is that the 60% is more like the core of your portfolio now. It means that is the base. That is where we are actually layering your portfolio around. So the satellite is now your 40% in equities. And don't forget that will still be premised on your capacity to actually take risk. So your
Yeah.
40% layering on it is what can actually help to actually amplify the valuation of your portfolio. So for someone just waking up now, it's still not very late, but it just means that you need to run faster than those people that already awake.
All right. Thank you for adding that, Eric. There. Okay. So, Adura, beyond the asset classes that we've talked about, beyond personal savings, are there useful resources like government programs, loans, grants, or platforms that people maybe in their 30s or 40s can access right now to, really kind of help them begin to build these investments faster?
Yeah, well, yes. When this government came, I mean, they created window for student education loan, right?
Mm-hmm.
These are windows that you can tap into to develop your human capital if it's
Yeah.
that important to you, because you need sufficient education, right, to prepare yourself to generate future income to begin to over time allocate to your financial asset as you grow from yourself to your financial asset. So you also have this real estate program by the Ministry of Finance, where you can tap into, run through the commercial banks, right, to give you exposure at a rate of 9% into real estate. But the 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 thing about it is, you need to look at where you are, right? You can't just it's not a decision you just wake up and say, I want to do this, I want to do that. So it depends on your cash flow capacity. If you have that cash flow and ability to, defray those obligations as they become maturing, then you can tap into those opportunities, to give you that leverage. But very importantly, as you age, if you want to grow, as you age, your engine is already your growth engine is weakening, right? So if
Mm-hmm.
it's weakening, for instance, if you look at a vehicle that you bought in the past, that spent 20 years, and you now want to repair the engine, you want to rev it up, you are standing, some of the risks you are standing is that the engine can break down along the line. So, and if that is the case, it means that you have to be very careful. At age 45 and above, it's still a long term, right? It means that at your income level, you must be ready to do at least 50%, 50 or 40%, savings at a go. You understand? So if
Mm.
you are able to, if you want to move at that at that growth that will catch up with what you have lost, it means that you have to increase. So it's no longer a time to be spending all your cash flow. It means that in fact, if you are very aggressive, you can do 50, you know, to investment, because those are the things that will give you stability as you progress. So you have to increase your run rate. Otherwise, you will not meet up. As you retire, then your income sources, stops to flow. That flow will stop, and when it stops, you are left with what you have. And if you don't plan what you have carefully, of course, the risk of depleting it, and you know what it is, emotion can set in when you it happens to everyone. You think
Yeah.
that, oh, I've lost it. Oh, how do I recover? For people that, if you trade, if you are for people that trade currency, in the international market, you know what it is. When you are leveraged, and now you are having losses against you, right? You now want to
Yeah.
come back. You now double your position, and when you double your position, you know what it means. It means that if the market
Taking
turn
more
against
risk.
you, it means that your debt is going to be twice as what it should have been. In fact, that one is direct. That person will end up in hell directly. So that's what it means. So that's the way I see it, doctor. Yeah.
Right. Thank you so much. I think it's been a wonderful conversation and one that we'll continue to explore. Now, we have a few more minutes, Deepo. We have a question from one of our listeners who was reacting to our last episode on top five stocks to purchase from the NGX and some of those opportunities from the dividend window that we have in June. So one is saying if they have about 5 million naira and they want to invest about for 5 years, are there particular sectors that you think they should be looking at?
Well, if I have 5 million and I'm investing for 5 years, it's more like
Yeah,
a
that's
long-term horizon.
that was the question.
And look at just what we discussed around the GDP. ICT ranked number one for me because that sector is currently printing cash. And if you remember some years ago, maybe about 2 years ago, MTN went to negative shareholders fund because of the FX loss. And I remember I mentioned clearly on one TV show like that MTN will be out of their negative shareholders fund. They will return back to positive just within 1 year of operation. And they were able to do that. Not that they were able to do that only. They even declared dividend in their Q3 result. And when you have checked their results in the last 3 quarters, you will see that upside momentum. So it means that playing in that sector will not be a bad idea for someone looking to actually invest for a long time. And, the financial sector is something that you cannot look down on. So I mean the banking sector. I'm actually a lover of the banking sector. They give you cash flows. They help you to actually predict your cash flow as well. And that's another sector I will look at. And I will also look at the oil and gas sector. And when you look at names and when I remember that about 3 years ago, Seplat was trading around 1,100 levels. The same stock is trading about 11,000. I'm telling you, I have ghost pimples when I remember that I was in the market when it was trading at that price, and also in the market about 3 years later, we're trading this. And one of the reasons why I feel the oil and gas sectors will thrive is because of the policies that the current administration is actually shunning out in respect of that particular sector. We heard from the Shell MD, where he actually mentioned that they are actually bringing a lot of funds, investment back to Nigeria. And don't forget that at the point in time, we saw more like capital reversal from the same Shell about some years back. And so it's because of the policies, attractive policies that we are seeing in that segment. So I will pick the oil and gas sector as my third. And I will pick in the industrial sector. Majorly the Dangote of this world, the WAPCO of this world. And why would I pick Dangote? I'll pick Dangote because stability. I'll pick WAPCO because it's currently being run by a Chinese company. And you and I know that when you have these guys come into any economy, they come with capital. They come with aggressive posture to actually want to take over that sector. And so we will see a lot of innovative activity on that, on WAPCO, and we'll see also catch-up activity on the part of Dangote, which would be a very good opportunity for people looking to actually play in that segment. And finally, I'll pick the consumer names as well. We have a couple of names in the consumer names as well, because Nigeria will continue to consume. And as we continue to consume, this company will try. As we continue to thrive, it means that as an investor in that sector as well, you also benefit from them.
All right, brilliant. Thank you so much for expanding more on that. And as I mentioned, it's been a pleasure having both of you. Dura Joe is a wealth management expert. He's joined us today to shed more light and provide context into these very two important discussions that we've had. Adura, it's a pleasure having you, and thank you for coming.
Thank you once again, Doctor. Thank you. It's a privilege to be here.
Right. And Deepo, it's always a pleasure listening to your insightful analysis. Thank you.
It's always a pleasure to be on the program. Thank you very much for having me again today.
All right. Thank you, everyone, for listening. If you do have a question, either for me or for my guest, please put them in the comment section. If you're someone above 50 already, and obviously you must have already passed through this, if you have a question and advice, some ways to navigate what we've been talking about, please put them in the comment section. If you are below 30, if you're below 50 and you're already in the process of putting structures in place, if you want to put some comments in the comment section, that would be appreciated. So please, if you're new to this channel, please subscribe to the channel and share this video with your communities and like this video on your way out. We are here every weekend providing contests, providing guidance, helping you make sense of the investment world. It's our pleasure, doing this again this weekend, and we are out. Thank you, everyone. Bye.